Hello and welcome back to another video. Today we're going to be looking at money market funds and I'm going to be explaining them in detail so that you understand what they are, how they work, as well as everything else you need to know before investing in them. So to start with, what is it? A money market fund is a type of mutual fund that invests in short-term, low-risk securities. The goal of a money market fund is to provide investors with a safe place to park their cash and earn a modest return, typically higher than a regular savings account or traditional checkings account. These funds are considered relatively low risk compared to other types of investments. Money market funds are commonly used by investors as a temporary parking place for funds between investments or as a component of a diversified portfolio. So how do they work? Money market funds work by pooling money from individual investors to invest in a diversified portfolio of short-term, low-risk securities. The primary goal is to provide investors with a stable place to park their cash while earning a modest return. Here's how the process typically works. Start with investor contributions. Individual investors buy shares in the money market fund by contributing money. The minimum investment requirement can vary, but is typically lower than other types of investment funds. Next, there's a pooling of funds. The fund manager combines the combinations from various investors into a pool of money. This larger pool allows the fund to achieve greater diversification and take advantage of economies of scale. Next, there's investment into short-term securities. The fund manager invests the pooled money into a portfolio of short-term, low-risk securities. These may include treasury bills, certificates of deposit, commercial paper, and any other money market instruments. Next, there's income generation. The fund earns income in the form of interest from the short-term securities in its portfolio. This income is typically passed on to investors in the form of dividends. It's also stable net asset value, also known as NAV. The net asset value of a money market fund is designed to stay stable at $1 per share. The stability of the NAV is achieved through careful management of the portfolio, ensuring that the securities held are of high quality and have short maturities. Finally, there's liquidity and redemptions. Investors can buy or sell shares in the money market fund at the current NAV on any business day. The fund must maintain high liquidity to accommodate redemptions, and the goal is to provide investors with quick and easy access to their cash. So what are the benefits? Start with capital preservation. Money market funds aim to preserve the capital invested by maintaining a stable net asset value of $1 per share. While they are not entirely risk-free, they are considered lower risk compared to many other types of investments. Another benefit is the liquidity. Money market funds are highly liquid, allowing investors to buy or sell shares on any business day. This liquidity provides quick access to cash, making them suitable for short-term needs or as a temporary parking place for funds. And finally, there's safety. Money market funds typically invest in short-term, high-quality securities such as treasury bills and certificates of deposit. This focus on low-risk instruments contributes to the overall safety of their investment. So now on to the negatives. To start with, there is a low return. Money market funds typically offer lower returns when compared to riskier investments such as stocks or bonds. While they provide stability and safety, the trade-off is lower potential for significant capital appreciation. There could also be interest rate risk. Changes in interest rates can impact the returns of money market funds. If interest rates rise, the yields on new securities may be higher, but existing securities with lower yields may lead to capital depreciation. And finally, there could be inflation risk. In periods of inflation, the return from money market funds may not keep pace with the rising cost of living. This could erode the purchasing power of the invested capital over time. So this has been my video fully explaining money market funds. Hopefully now that you've watched this video, you understand everything you need to know, and you can use some of what you learned in this video to assist you when looking to invest in these in the future. I also hope you found this video helpful, and if you did, please comment down below to say it helped you out, and like and subscribe for more content like this. Thanks for watching.